So there are new products that are being launched by BlackRock, by many other companies. Okay, these assets or these new products that are being launched are called buffer products. Okay, you guys should pay attention to this. You really should, and then talk to your families. If you're thinking of dollar cost averaging, like with DCA, right? S&P 500 has done well all this period, right? Well, actually, let's just look at this. S&P 500 now is up 33% from its October 2023 low. Think about this, people. We're not talking years. October 2023, less than a year ago, it's up 33%, above 5,500. Since October 2023, the index has now added 11 trillion of market cap. Okay, that's more than the value of China's entire stock market. Think about this, people. Just the increase, not the whole thing, right? It also 4 times the GDP of France and 5 times the GDP of Canada. S&P 500 has more than tripled its average annual return, which is about 10 and 10.5%, including in reinvesting dividends in just 8 months. Now, a lot of people are saying this is a tulip, this is going to die, massive correction is coming. Trend is up. Okay, I told you guys the first time I did the live stream, trend is your friend until proven otherwise. You follow the trend. I mean, picking bottoms on a market that's up 33% is going to take you to the poorhouse continuously. But then BlackRock and these other companies are coming out with these new products. They're called buffer or risk managed ETFs. So let's say you have the SPY. You have risk in the SPY. Meaning if the SPY cracks and goes down 20%, you just lost 20%, right? But if your dollar cost average over long periods of time, you should be fine. However, these geniuses came out with this product, okay? BlackRock has launched a buffer exchange traded fund that seeks to offer, listen to this now. Do you guys think the timing of this is a little odd? Do you think BlackRock knows something? I mean, BlackRock owns the country, by the way. Do you think BlackRock knows something we don't know? Most likely. BlackRock has launched a buffer exchange traded fund that seeks to offer 100% downside hedge risk. Think about this. They're offering you 100% downside hedge to the S&P 500. I'm going like, well, that's wonderful, right? I have no risk. I'll just invest in this and have no risk. But then I read the small print, and the timing of it kind of caught my eye, right? I mean, why was this product not coming out like a year ago before the market went up 33%? So I think this is a very timely product, and I may actually put some of my retirement money into this. So 100% downside hedge, 100%. You can't lose. Too good to be true, right? In our world, when we say you can't lose, you're in trouble. No guarantees. The so-called buffer or risk managed ETFs help maximize returns from an asset for investors and simultaneously provide downside protection over a specific period. That's the caveat. Okay? That specific period, those 2 words. I was like, okay, now I got to read the small print some more, which I did for you guys, which you guys will understand. And okay, so that's my Robinhood thingamajiggy. So, okay, there was another screenshot on this. But so the fund, you guys can Google this. What the fund does, people, is it caps your upside at 10.6%, which is the average return of the S&P 500, going back 150 years. Get it? But if you bought the S&P 500 today, okay, expecting for the next 12 months, S&P 500 performing at 10.6% plus up this way, right? But something happens, another pandemic happens, whatever happens, S&P 500 tanks 30%. Without this product, you would be losing 30%. Fact. But with this product, you can participate on the upside by a limit of 10.6%. Now, it could be 20%. You guys are going to say, well, who's going to make the next 10%? Well, I'm pretty sure that's why BlackRock is giving you a 10.6% upside cap, which has been the average in history. And with certain derivative strategies, they are guaranteeing your principal. So let's do this math. Let's put in $1, okay? in the S&P 500 today. By the end of the year, if the S&P 500 is up 10%, you will have $1.10. All yours. If it's up 20%, they'll keep the rest. You'll still get your $1.10 though, which is a good return, 10.6%, right? But what if the S&P 500 cracks? What if we go in a recession, S&P 500 tanks 30%? Then what do we have? Then that dollar you invest today is only 70 cents. Well, with this, for a period of 12 months, only 12 months, people, that's the specific period when it comes into play, you have guaranteed 100% no loss for 12 months. After that, whatever happens, happens. Another 12 months time frame kicks in. I think this is a valid product, especially if you're investing these days after the market has gone up 33% in 8 months. I think the timing of this is a little bit of, funky to me, but then, hey, it is what it is.